Mutual funds have performed well in the past with a minimum of 12 to 15% and about 20% in some cases, and the trend is expected to continue. With hardly any research or time that you need to spend, you can just leave it to the fund managers who will take care of all the investments. So in this video, you will discover the power of mutual funds and how you can diversify your investments and maximize your returns with different types of mutual funds. Okay, so what is mutual fund? What are the different types of mutual fund? And what is the best one for me? So these are some of the common questions that we have. For a beginner or for a busy working professional who wants to invest in equity but do not have time to do so, this is the ideal option. Consider this example of Raj, who wants to build a house. If he had the knowledge on designing the house, which stone to buy, what grade of cement to be used, getting the people to work on the construction site, all the raw materials that are being used, flooring and electrical work, and lot many things. If he were to do all of these, it would take all of his time, and he has to be an expert in each of them. Now let's compare this with equity market, where he has to be an expert in each of the shares that he has to invest in. If Raj were to go to a builder and pay lump sum or stage-wise, more like an SIP, this builder will take care of the complete construction work. This is exactly how mutual fund works, where instead of builder, you will have the fund manager who will take care of all the work. This builder will charge small amount or commission, and the same applies in mutual fund, where there will be something called expense ratio. By the way, have you been investing in equity directly or via mutual fund? Leave a comment below and let me know how well it is performing. So when it comes to equity, lower the age, higher the risk that you can take. So it is recommended for people of lower age who have just started their career to invest more in equity than a senior citizen who may have no source of income, and it is recommended to have smaller portion in equity. In short, it depends on risk capacity of the individuals. Watch this video till the end because I'll be sharing some of the bonus tips. So there are three main categories of mutual funds, that is the equity fund, debt fund, and hybrid funds. Equity is considered high risk as the returns can vary. Usually you get high returns when you stay invested for long term. Also, you pay lower tax when compared to fixed deposits. Equity market is closely monitored by SEBI, and too many restrictions are in place which will keep the investors' money safe. Under equity, we have the large cap or the blue chip mutual funds, which has larger market cap. These are the top companies, reputed ones, and trustworthy, that is stable, of medium to high risk, and of lower volatility. Next is the medium cap mutual funds, which are of medium market capitalization. These are mid-level companies that are stable, high risk than the large cap, but lower risk than the small cap. Next is the small cap mutual funds, which has smaller market cap, highly risky and highly volatile. You can see the stocks hitting the upper and lower circuit breaker quite often. Next is the multi-cap fund, where the amount is invested across companies regardless of size and sector. This will help in diversification by investing in companies spread across the sector and market caps. Here the investment happens within equity. ELSS, Equity Linked Savings Scheme, is a dedicated mutual fund to save tax under ATC and has a lock-in of 3 years. You can claim tax benefit under the old tax regime. Moving on from equity fund to hybrid funds. So in hybrid fund, investment happens between equity and debt. Hence the risk is balanced out. Higher the portion of investment in debt fund, safer it is, but lower returns when compared to equity. Next is the sector or thematic funds. They invest in a particular sector like banking, renewable energy, oil and gas, information technology, IT, pharma, etc. This is highly dependent on government's yearly budget allocation and plan or long-term plan of the government. For example, green energy is being given importance by the government for the next 10 years, and the renewable energy sector will grow up. Another example would be the IT sector, which will come down when there is a war or when there is a recession. Moving on to the debt fund, which is stable and safe, and you can expect fixed income. It has good and higher single digit returns, just above inflation post tax, but higher tax. Under debt fund, we have liquid fund, where they invest in money market instruments having a maturity of a maximum of 91 days. It is ideal for short term investment and a better option for keeping lump sum in bank SP. But this involves market risk with an interest similar to that of bank FD. There is no lock in liquid funds. Next is the money market funds. This has a maximum maturity of 1 year, ideal for low risk and for short term. The one after this is the dynamic bond fund, ideal for long term of more than 4 years with moderate risk tolerance. Here, the money is invested in debt instruments for varying maturities based on interest rate regime. Followed by this is the corporate bond funds, where investment will be done on minimum 80% of higher quality corporate bonds, which has high ratings. This is of low risk. Next is the gilt fund. They invest minimum of 80% of its investable corpus in government securities. No credit risk, but interest rate risk is high. So now that you know the different mutual funds here in India, here is what you need to know about taxes and other fees. Entry load is 0 in most of the cases, whereas there is an exit load of 1% usually when the amount is taken out within 1 year of investment. If you go for an SIP, then the investment that you have done in the last 1 year of your SIP will have an exit load if you exit. Also, this last 1 year will come under short-term capital gain tax, whereas investment with more than 1 year horizon will come under long-term capital gain tax. Also, the debt mutual fund will be taxed as per your income tax slab. So before I go ahead with the bonus tips, a gentle reminder to subscribe to my YouTube channel and also to like this video. So now that you have watched and hope the content was useful, let me share some of the bonus tips. Check expense ratio. It is ideal if it is less than 1%, and a maximum of 1.5% should be okay, even though there are a few where they charge up to 3%, which is super high. Next is go for an SIP, and when the market is down, invest lump sum in addition to SIP. Next is to increase your SIP every year by 10% for much better returns. The next tip would be check the returns and how it is performing every 3 months and take a decision if the performance remains poor for more than 6 months to 1 year. When investing in mutual funds, check if there is an overlap of stocks. Having the same set of stocks in 2 different mutual funds doesn't make sense. And the next would be to avoid taking loan as much as possible and do not pause or stop your SIP based on market conditions. The primary purpose of SIP will be broken. If you like this video, then go ahead, subscribe to my YouTube channel for more valuable tips of this kind and also help you grow financially. I'll be coming up with another video with more details on the bonus tips that I've just shared. Meanwhile, you can go through my next video on unveiling the truth, stock market myths busted. Thanks for watching.